McGraw-Hill Ascent Audio presents Nothing But Net, 10 Timeless Stock-Picking Lessons from one of Wall Street's top tech analysts, by Mark Mahaney, narrated by Mike Lenz. Publisher's note: in this audio edition, you will hear references to figures and tables present in the print and ebook formats of the book. Preface: the oldest and longest-lasting Internet analyst on the street. I am the oldest and longest-lasting Internet analyst on Wall Street, and I've been lucky, very lucky. For almost 25 years, my job has been to cover Internet stocks, to write about, model, analyze, discuss, and explain arguably the most dynamic and interesting investment sector on Wall Street. I've had the opportunity to track some of the most innovative companies of the last quarter century: Alibaba, Amazon, AOL, eBay, Expedia, Facebook, Google, LinkedIn, Netflix, Pandora, Priceline, Snap, Spotify, Twitter, Uber, Yahoo, Zillow, and others. I've had the chance to meet and get to know, sometimes barely, sometimes well, some of the leading entrepreneurs and CEOs of the last 25 years. Jeff Bezos, Reed Hastings, Meg Whitman, Steve Case, Mark Cuban, Eric Schmidt, Jack Dorsey, Jeff Boyd, Dara Khosrowshahi, Tim Westergren, Evan Spiegel, and Doug Lebda, to name a few. And my stock calls have had their share of failures, but also many dramatic money-making wins. I've had a buy on Google for most of the past 10 years, as that stock has climbed 465%, from $310 in early 2010 to $1,750 at the end of 2020. I upgraded Facebook to a buy after its 50% post-IPO correction and have reiterated that recommendation ever since, as the shares have jumped 1,265%, from $20 to $273 at the end of 2020. I've had a buy on Netflix for the last 10 years, as that stock has soared over 2,000%, from $25 in early 2011 to $541 at the end of 2020. I've had a buy on Amazon.com for 15 straight years, as that stock has exploded 7,300%, from $44 in early 2005 to $3,250 at the end of 2020, making Amazon one of the most valuable companies on the planet. Those four stocks have helped create one of the most lucrative investment portfolios, FANG, as in Facebook, Amazon, Netflix, and Google, of the past several years, and I've been with them every step of the way. Lots of skill and lots of luck. I've also been unlucky. I was laid off by Morgan Stanley in 2003 in the wake of the dot-com bust, after working there for 5 years as the top associate to legendary analyst Mary Meeker. I was also fired by infamous hedge fund manager Raj Rajaratnam at Galleon for not getting enough edge after grinding it out in that trading snake pit for a year. That firing turned out to be a blessing in hindsight. Still, firings are never fun. And I was terminated by Citibank for a violation of that company's media disclosure policies. A highly painful experience on both a professional and personal level, after working extremely hard there for 7 years, building the leading Internet research franchise on Wall Street. As I look back on my career, I was hired into the dot-com boom, highlight the eBay IPO in 1998, fired out of the dot-com bust, lowlight the 90% correction in Yahoo shares in 2000 to 2001, rehired into the dot-com revival, highlight the Google IPO in 2004, fired out of the dot-com controversy, highlight the Facebook IPO in 2012, and hired back in for the dot-com takeover, highlight 3 of the largest market cap names in the world are now Google, Amazon, and Facebook. Throughout these years, I have been all net all the time, nothing but net, and always online, my email signature taglines over the past 25 years. Like most people growing up over the last 20 years, I am now modestly over 50. The internet has been deeply interwoven in my life. When my first son, Noah, was born with Down syndrome, I begged for access to a computer in the NYC hospital so I could order every book on Down syndrome that Amazon had and join every Down syndrome user group hosted by Yahoo. And every year, on the anniversary of my dad's and mom's passings, I repost on Facebook the eulogies I gave at their funerals. Yes, this is going to be a personal book. I also was consistently among the early adopters of services and products like Gmail, Netflix streaming, Facebook, Twitter, the Kindle, Alexa devices, Google Glass, Snapchat spectacles, the Amazon Fire Phone, Stitch Fix, Oculus virtual reality headsets, and Uber, partly out of a fun fascination with new services and products, and partly out of a need to stay on top of my sector. Later, my 4 sons came to generate, not always consciously, some of my best insights into the newest social networks like Instagram, Snapchat, and TikTok. Analysts do a lot of odd things, like looking for correlations in unusual places. Here's one. My oldest son, Noah, was born on March 12, 2000, just 2 days after the NASDAQ peak of 5,048. Almost from the beginning, I nicknamed Noah the Bear, not at all realizing that his birth date marked the beginning of a multi-year bear market for tech stocks. Then came Carter, born November 20, 2001. I nicknamed him the Kangaroo. And what do you see if you start the NASDAQ chart on Carter's birth date? Lots of ups and downs. Then there was Aiden, born on August 5, 2003. His nickname? The Bunny. And lo and behold, you'll notice a lot of big hops if you start the NASDAQ time machine on that date. Finally, there was Malcolm, the Monkey, born April 4, 2007. And yes, the NASDAQ charts show mostly an upward climb if you start on that date. Anyway, I told you analysts do a lot of odd things. Because of all my work on the internet, and because of the growing importance of tech and internet stocks, I have become something of a trading floor name. Over the last 10 years, the number of TV interviews I have done on CNBC, Bloomberg TV, Fox TV, and other outlets has totaled well over 500. Over that time, I've also done over 1,000 print interviews with the Wall Street Journal, the New York Times, the San Jose Mercury News, USA Today, the San Francisco Chronicle, and a series of other publications, including one with an obscure French business magazine, Le Capital, I think, that helped lead to my firing by Citibank. 2 years ago, Business Insider published an article on 36 hours in the life of a tech analyst and featured me. If you Google sexy internet analyst, you will quickly find a link to a New York Times article about me and 2 other analysts. The article had nothing to do with our sex appeal, which was surely pretty limited unless Excel spreadsheets are your thing. But it had a lot to do with how influential we had become regarding publicly traded stocks. And if you work through the Twitter sphere, you will see a graphic reference to me as a horse's ass for having a sell rating on Twitter. So, yep, lots of publicity. Most good, but some bad. I've now covered the internet sector for almost a quarter century, longer than some of my clients and colleagues have been alive. That makes me feel old. But it has been an extraordinary opportunity to watch, track, and analyze the birth and growth of an entire new industry. Kind of like being an autos analyst in the 1920s, when cars became popular and common. Kind of like being an airlines analyst in the 1950s, during the golden age of air travel. And kind of like being a cable analyst in the 1970s, when cable TV expanded into major cities and metro areas. Good calls, bad calls, Peter Lynch calls. Over the last quarter century, my job has been to make calls on internet stocks, to buy, to hold, to sell. My job has been to answer questions about internet stocks, which ones to buy, when, what price levels, what are the catalysts, which management teams appear great, which appear suspect, what are the biggest competitive risks, how big or how small are the market opportunities, And perhaps most importantly, as I've learned over time, where is the product/service innovation the best? The worst? I've experienced some truly memorable moments covering internet stocks. One, gazing in awe, along with Mark Cuban, as Broadcast.com's stock soared 249% on its IPO trading day. At that time, the biggest one-day pop for an IPO ever. Was Cuban upset about all that money being left on the table for investors? Nope. He viewed it all as a great marketing event for his company. 2. Watching Jeff Bezos leg wrestle Joy Covey, Amazon's then CFO, at a dinner following a 1999 Investor Day in Seattle. I actually don't remember who won, but it sure was entertaining. 3. Watching eBay CEO Meg Whitman celebrate, very briefly, when eBay's market cap surpassed Yahoo's for the first time during a Morgan Stanley Tech Investment Conference in Scottsdale, Arizona in 2000. You bet CEOs keep score. 4. Having Mark Andreessen, founder of Netscape, and now arguably one of the most influential venture investors in the world, warn me at a 2005 industry conference that Microsoft would never allow Google to succeed. And 5. A series of phone calls with famed investor Peter Lynch. Lynch actually called me several times in 2015 when he was doing research on Groupon, the online coupon/shopping deals company. Groupon was arguably a classic Lynch stock. At the time, it was widely hated and dismissed by tech investors and had materially underperformed its peers and the market. But the company had a rock-solid balance sheet and was in the process of a potential turnaround. Lynch's questions to me were detailed and insightful. He totally challenged me, and then I challenged him to avoid Groupon and instead to dig into Google and Amazon. I don't know how or whether Lynch decided to invest in the net sector, but I recall our conversations vividly, with nothing but respect. I have made plenty of stock calls, plenty of great calls, plenty of so-so calls, and plenty of terrible calls. Among the great calls: 1. Placing and defending a buy recommendation on Netflix from 2013 to today. Per CNBC, Netflix was the single best-performing S&P 500 stock, by a long shot, for the 2010 to 2019 decade, rising almost 4,200%. 2. Maintaining a buy recommendation on Amazon from 2005 to today, from $44.29 on December 31, 2004, to $3,257 at the end of 2020, a rise of 7,254%. I'm not even going to bother fact-checking the following statement. Amazon has been the single best-performing S&P 500 stock by a very, very long shot over the past 15 years. It helps that Netflix wasn't added to the S&P 500 until 2010. 3. Pitching PCLN, Priceline.com, now Booking.com, as a buy recommendation from 2008 to 2018, when it soared 1,524%, from $107 to $1,738. Among the terrible calls: 1. Initiating coverage of Blue Apron, the online meal kit delivery company, in July 2017, shortly after its IPO, with a buy call and a $10 price target, with the stock at $6.55. Now, you might pull up the Blue Apron ticker and see the stock trading at around $6.50 in December 2020 and think, Mark, that's not exactly terrible. But a quick Google search will also show that Blue Apron did a 1-for-15 reverse split in mid-2019, which really means I slapped a buy on Blue Apron at $98.25, which means an investor buying Blue Apron on my recommendation has lost 93% of his or her stake. That is terrible. 2. Placing a sell recommendation on Twitter in September 2016 with the stock at $18.49, on the thesis that it was overvalued and its fundamentals were deteriorating. then upgrading it to hold a year and a half later in February 2018 with the stock at $31.22 after a 69% climb. Shoot, that was also a terrible call. 3. My worst call of all time, slapping a sell on Google prior to its first earnings report in October 2004. Google shares had soared 50% from its IPO. I thought that rise was excessive. I wrongly believed Yahoo to be a better fundamental asset. I made the mistake of trying to play a quarter, and I underappreciated the amazing innovation and market opportunity of Google. Despite my call, Google posted very strong quarterly results. Its stock rose 15% the next day and continued to rise aggressively for another year as search advertising took the advertising market by storm and Google gobbled up market share. How many calls have I made? One way to think about it is that every quarter I've had a chance to reevaluate a stock call, to affirm a call, to upgrade, or to downgrade. So for fun math, over 20 years, that's 80 quarters, and with roughly 30 stocks under coverage, that's 2,400 calls. But that's not the right way to think about it, because with stocks always moving and news flow constant, there's an opportunity to reevaluate stock calls daily. This is something some of the Twitch trigger hedge fund analysts do, and some of them do it very well. So from this angle, that works out to 20 years, roughly 200 trading days a year, roughly 30 stocks, so that's 120,000 calls. My mind is spinning just thinking about that. Thankfully, that was never my mindset, though knowing why any one of my stocks was up or down materially on any given day was my job. The simple point here is that I've made lots of stock calls. In arguably the most dynamic, best-performing stock sector on Wall Street over the past 2 decades. And I've learned a thing or two along the way. Actually, 10 key lessons. And I'm going to share them with you in this book. Some roads lead to Wall Street. In his book Outliers, Malcolm Gladwell makes the keen insight that much of success is simply luck, being in the right place at the right time. Similar to the statement that 90% of success is simply showing up. But if you want to really be successful, you have to show up at the right place at the right time. And showing up to analyze the internet sector in 1998 was exactly the right place at the right time. Like I said, I have been very, very lucky. My luck occurred because in 1998, a Wharton Business School classmate and friend of mine, Chris Buva, was kind enough to give me some of the research reports published by one Mary Meeker, who, for over a decade, was the Internet analyst at Morgan Stanley. She was also the lead author of the Internet Report, a 150-page primer on the Internet sector published by Harper Business in 1997. I vividly remember that report because a Wall Street Journal article on it sent me scurrying down to the Barnes & Noble in downtown Philadelphia looking to buy it. Irony. It was my reading of that report, from cover to cover, that truly ignited my interest in a Wall Street career covering the Internet sector. Anyway, back to my luck and Chris Buva. Yes, he was kind enough to meet me in the lobby of Morgan Stanley, where he worked, to hand me some of Mary Meeker's research reports. But he was also kind enough to inform me that one of Meeker's 2 associates was soon to be leaving, and Meeker was on the lookout for a new hire. Was I interested? Was I? So if there's one person I am most in debt to for launching my Internet Wall Street career, it's Chris Buva. Thank you, Chris. What then followed was a 6-month interview process that ended with me joining the Morgan Stanley Equity Research Department as an associate to Mary Meeker. That process involved me meeting several times with the associate who was leaving, a guy named Russ Grandinetti, who was leaving for what turned out to be a fantastic career with a tiny little online retail company called Amazon.com, where he helped launch the Kindle product line, among many other achievements. I remember telling a friend when I was interviewing at Morgan Stanley that my hope was to become Russ Plus. Russ, I don't think I ever achieved that status. That 6-month interviewing process also involved me meeting with the then head of Morgan Stanley's Technology Investment Banking Group, Ruth Porat, who later became the firm's CFO and later still the CFO of Google. One of my career ironies, or lucky breaks, is that I only met Porat because Morgan Stanley became concerned that I was also interviewing with core competitor Goldman Sachs and its internet analyst, Michael Parekh. The truth was that I had met with Parekh, though I hadn't begun any formal interview process there. Somehow or other, Morgan Stanley found out that I had met with Goldman. I don't know, maybe I mentioned it in passing. Don't quite recall. And that led Morgan Stanley to accelerate its interview process. Shortly thereafter, I was hired. Anyway, that's it. All the history about me that you need to know, at least for the purposes of this book. Introduction. The Big Long. In 1989, famed Fidelity portfolio manager Peter Lynch published One Up on Wall Street, a New York Times bestseller that aimed to help individual investors succeed in the market. That book contained a lot of great company and stock stories and introduced to many the concept of 10 baggers, stocks that can rise tenfold over a reasonable period of time and dramatically outperform the market. Lynch advised individual investors to look for everyday investing opportunities all around them. For example, Dunkin' Donuts, Pep Boys, The Limited. To be patient and to keep a lookout for tomorrow's big baggers. Well, the internet sector has been chock full of 10 baggers. By my count, the U.S. internet sector has produced, up through the end of 2020, at least 23 10 baggers, stocks that went up at least 10x, including 2 300 baggers, Booking.com and LendingTree, 1 400 bagger, J2 Global, 1 500 bagger, Akamai, and 2 hefty super jumbo baggers, Netflix and Amazon. Netflix has been a 1,500 bagger, 1,500x, up from a low of 37 cents in October 2002 to a high of $557 in September 2020. And Amazon has been a 2,500 bagger, 2,500x, from a low of $1.40 in May 1997 to a high of $3,531 in September 2020. Yes, there have been a lot of duds in the internet sector, stocks that underperform the market or simply traded in line with the market for substantial periods of time. But there have also been some dramatic 10-bagger performances. In 2000, Lynch wrote an introduction to the Millennium edition of his book in which he touched on the hot topic of the day, internet stocks. He described himself as technophobic and skeptically referred to Amazon as one of at least 500 .com stocks that have performed miraculous levitations. At the time of that publication, I was working at Morgan Stanley under famed internet analyst Mary Meeker, trying my best to figure out whether there really was value in the internet sector. And I vividly recall Morgan Stanley's senior marketing strategist stopping me in the elevator, pointing his finger at me and asserting, "You know Amazon will never be profitable." The truth is, I didn't know. And yet, Amazon did eventually, many years later, start generating substantial amounts of GAAP EPS and free cash flow, FCF. In fact, Amazon is now on track to be one of the largest generators of annual FCF of any company in the world. And its stock became a 10-bagger many times over, like 250 times over. Tech stocks have delivered almost unprecedented performance over the past 2, 5, and 10 years, with the Nasdaq up 94% over the 2 years ending December 31, 2020, up 157% over the past 5 years, and up 386% over the past 10 years. For each of these periods, tech stocks, aka Nasdaq, have outperformed the overall market, aka the S&P 500, by roughly 2x. Key point: tech stocks have been where it's at. And very near the center of this dramatic outperformance by tech stocks have been U.S. internet companies. Stalwart names like Facebook, Amazon, Netflix, and Google, now called Alphabet, the FANG stocks, have dramatically outperformed the market, rising on average 52% in 2020, 99% over 2019 to 2020, 262% over the 5 years 2016 to 2020, and 1,219% over the decade 2011 to 2020. These companies have also become living room names. For good and for bad, my and your teenagers couldn't survive a day without checking in with Facebook's Instagram. For a while, in late spring 2020, as the COVID-19 crisis affected our lives, the only retail outlet most Americans could reliably count on was Amazon. Netflix has become so influential that a short series it produced on a young chess whiz, The Queen's Gambit, caused a run on chess sets around the world. And Google, well, it's everywhere. It's also become part of what I call the lucky lexicon. Company names that have become ubiquitous verbs, like Xerox and Coke in the past. Like Google or Twitter or Uber or Airbnb today. There's much more to the net sector than just FANG, however. Many other net stocks and companies have added to the sector's allure and investor attention, including Booking, Knee Priceline, Chewy, eBay, Etsy, Expedia, Grubhub, Lyft, Pinterest, Shopify, Snap, The Trade Desk, Twitter, Uber, Wix, and Zillow. 2020 was one of the strongest IPO years on record in terms of funds raised, and several of the highest profile, highest popping IPOs were internet stocks. Airbnb and DoorDash near the top of the list, with both rising close to 100% on their first day of trading. The blockbuster Airbnb IPO was particularly noteworthy because it occurred while the company was still recording, thanks to the COVID-19 crisis, 30% year-over-year declines in its bookings and revenue. Growth companies are typically expected to be, well, growing when they stage their IPOs. Airbnb was declining, and it still pulled off a highly successful IPO. Wow. Reflects a lot of trust and hope by investors in Airbnb's secular growth opportunity post-COVID-19. A lot. And imagine how much interest there would be were TikTok, one of the fastest-growing internet apps of all time, to announce its IPO intentions. The COVID-19 crisis made some of these internet companies indispensable. We needed Amazon to keep our pantries and closets stocked during the pandemic. We needed Netflix to keep us entertained and distracted. Pet adoption surged, and so did the customer count at Chewy, rising by at least 1 million per quarter for 3 straight quarters in 2020. People looking to express their individuality while staying safe flocked to Etsy to buy designer masks. In the June quarter of 2020, Etsy added 12.5 million active buyers, nearly as many as the 2 prior years combined. With dine-in options severely curtailed, food delivery companies like DoorDash became a lifeline to both small businesses and consumers. Dash's revenue rocketed 214% year-over-year in the June 2020 quarter, and then 268% in the September 2020 quarter. The stocks of these companies and others reacted accordingly. Amazon up 72% in 2020, Netflix up 64%, Chewy up 203%, Etsy up 294%, and Dash up 17,000%. Okay, that's annualizing the 85% pop Dash had on its first trading day. Still, the point holds.
Sample complete. Ready to continue?